Okay, so I will try to be very, not very slow, but a little slow in my delivery so that you don't miss any valid point. So yesterday I hinted you about this double entry principle, right? Now this is the principle. I gave you the name of the man who, propounded this principle. What is the name of the man who brought this double entry principle? In fact, if you forget that name, I'm ending the class now. Yes, who propounded the double entry principle? Yes, Nicole.
Sir, please, Fra Luca Pacioli.
Okay, thank you. So most of the times he's seen as the father of accounting, right? Like Adam Smith is the father of economics. Okay, so this is the principle. When you are asked to state the principle, this is it. For every debit entry, there should be a corresponding credit entry, right? And vice versa, which means, in fact, in exams, avoid using the vice versa and write it in full. So for every debit entry, there should be a corresponding credit entry. And for every credit entry, there should be a corresponding debit entry. So that's it. That is the principle. If you're asked to state the principle, if you're asked to explain, then after stating, you go ahead to give us, the length and breadth of the principle. So what the principle means is that every transaction basically has two effects. Okay. I think I hinted you about this. It's either one thing is increasing and the other is increasing, or decreasing and the other is decreasing, or one is increasing, the other is what? Decreasing. Okay. Now, what is increasing and what is decreasing? The items that are increasing or decreasing may be an asset, a liability, capital, income, or expense. Okay. So when you are given the transaction, your major task is for you to determine whether the element in there are assets, liability, capital, income, or expense. And as Luca Pacioli posited, you need two of those items because one has to increase for the other to decrease, or one has to increase for the other to increase. You need that two effect. So essentially, you also need two elements in accounting so that you can analyze which one is increasing and which one is decreasing or otherwise. Okay, great. Now, if you're able to do that analysis, it doesn't end there. He says that you have to record this increase and decrease by using some entries, and he named them debit entry and credit entry. He now went on to say, well, this debit entry and credit entry, you should do it in something we call an account. And he drew the account in this format. Okay, the one that you know, the T. So with the left side, the debit side, and the right side, the credit side, which I'm sure we all appreciate, that the left side of the account is the debit and the credit side is the right side. Okay, that's when you are facing the account. So when Luca Pacioli says make a debit entry, it means put it on the left side. A credit entry means put it on what? The right side. But each of them has a unique meaning. Okay. Devoid of the fact that we are putting it at the left side, and for that matter, it's a debit entry. It has a meaning. Okay. And the meaning is linked with the element of accounting, as I've mentioned. So let's look at what I'm talking about regards the element of accounting. Okay. So let me grab my pen. So yesterday I told you that there are 5 of them, but the ones you see in the equation are 3. That's the asset, liability, capital. But the expense and income are also the other element of accounting. So assets, right? You have the assets, We have the capital, and then we have the liabilities. Okay, I'll talk about the income and expense later, but let's focus on these three. So when you are given a transaction, you need to determine whether there is an asset, there is capital, or liability. In some cases, both will be assets. In some cases, you would have a liability and an asset, or capital and what? A liability. It can happen. You would have to do that analysis based on the transaction given. But what I want you to note is, if an asset is increasing, so let me use the plus sign to denote increase. If an asset is increasing, Luca Pacioli says debit that asset account, debit. And I believe now you know debit, which is go to the left side of that account of the asset and put the entry there. If the asset is decreasing, I'm using minus to denote decreasing, then what will we do? We are going to credit it. So this is the principle according to Luca Pacioli relating to assets. So if you have a transaction where you have determined an asset, the question you ask yourself is, in this transaction, is the asset increasing or decreasing? If the asset is increasing, then it means when you open that assets account, you debit it. If it is decreasing, you credit. Okay? Now, yes, Prof. Nicole.
So please, are we supposed to memorize it, or is there like something behind it for us to know why we have to debit and credit?
Okay, so you would have to memorize because it's a principle. It's just like a law, right? You would have to memorize it first, and then maybe you begin to appreciate the rationale for doing that. But in this case, it will be difficult for you to know why Luca Pacioli says when assets increase, we should debit. What informed that his prescription? It becomes difficult for you to understand because it is a theory or is a principle he has developed. So he could have said that when asset increases, we should credit. And that would have been the principle. So I would answer, or I'll give an answer to your question by saying that you need to memorize it. That according to the double entry principle, when an asset is increasing, we debit. And when it is decreasing, we do what? We credit. You need to memorize that. It's non-negotiable. But the interesting thing about it is it will not change. In Ghana, it's the same. In the United States, it's the same. Okay, it doesn't change. The principle is the same. That's the beauty of it. But you need to memorize it. And mundi baba kakra. Why? But I think it's so easy to remember this thing, right? Now for capital, when capital is increasing, we credit. Okay? And when it is decreasing, we do what? We debit. So at this point, at least, you know that capital is what the owner is investing, right? The resources the owner of the business is investing in the business. Okay. So you can tell whether that investment is increasing or decreasing, and then you appropriately do the entry. For liability, when liabilities increase, let me ask my professors, maybe one of us can, tell us. When a liability is increasing, what do we do? Any suggestion? Yes. You just guess. If you get it wrong, nothing, because we are now learning the principle. If liabilities increase, what do you think we would have to do? Do we debit or credit? My professors don't want to commit. Let me move on. So when liabilities also, okay, Michael.
Sir, please, you debit.
So when liabilities, I think was it about the increase? If liabilities increase, we credit, okay? And then when they
Yes,
decrease,
sir.
we debit. So the decrease
Decrease,
is
we debit.
exactly. So the debit is for the decrease. So you have to remember this. If you want to be very successful with recording transactions, you have to remember it. There are other means of, getting to know the principle, but I prefer the elements of accounting. You can also use the types of account, okay? And that is where your teachers normally, hint on or hit on. And most students even take that as the principle, okay? You can also look at the principle from the types of account. So when I say types of account, in accounting, it's either you are dealing with human beings or you are dealing with things that are not human, okay? So we group account into personal and impersonal. The personal are the human beings, but even the human beings, we acknowledge artificial human beings, and that's the businesses or the companies. So MTN is seen as an artificial human being in accounting. So we term MTN as a person, okay? So if you categorize account into personal and impersonal, then if you pick or you want to apply the double entry to personal account, then we say debit the receiver, credit the giver. So that principle, which I'm sure majority of you think is the double entry principle, it's not the double entry principle. It's an application of the double entry principle to personal account, because persons can receive and give, right? So if you are applying the principle to personal account, then they say debit the receiver, credit the giver. So if you have a transaction, for example, sold goods to Kofi. Kofi is a person. So you then do the analysis. Is Kofi receiving or giving? So if you determine that Kofi is receiving, then you have to debit Kofi's account. If Kofi was giving in that transaction, then you do what? You credit. So in the example I gave, sold goods to Kofi. So Kofi was receiving the goods, right? So we debit the receiver, Kofi's account, right? And then when you look at the impersonal account, that is things that are not human. That too, we can divide it into two. We have the real and nominal. Okay, I think I should be writing some of these things for you to take notes. Or you are okay, because I was expecting, or my expectation is that you might have discussed it in school. If not, let me put them down as notes for you to take. So which is which? Okay, the silence means my professors are good, so I can move. Okay. But by way of recapping, I said that you can apply the double entry principle looking at the elements of accounting, okay, which is asset, capital, liabilities. And I've just mentioned what happens if these elements are increasing or decreasing. In fact, let me add the expenses and income so that you appreciate. The expenses behave like the assets, okay? The expenses behave like the assets. And then the income behaves like the capital and liability. Okay, great. So I think you can take this point down. Then when you look at the types of accounts, okay, I mentioned personal and impersonal. So let me put that also here. Please, can I clean these points? Can I clean them? Or you want to write? If you want to write, let me allow you some minutes to write.
Yes, sir.
Okay, so 1 minute, just put it somewhere in your notes. Well, I think when I was teaching this in class, I gave my students some shortcuts to remember this, and I said asset plus debits, asset plus debit. So plus is increase. When assets increase, you debit. So asset plus debit. If you get that point, definitely you get the other end that if it decreases, we'll credit. Okay. And then with capital, liability, and income. So capital is capital plus credit. So C plus C. So we have A plus D and C plus C. A plus D, C plus C. You can make it a music, learning should be fun. It's not always going to sit down and then you read it, make it fun. Okay. A plus D, C plus C, A plus D, C plus C. So A plus D is asset increase debit. A plus D, A plus D debit, A plus. And we know A plus is a politician in this country. So A plus D. And then C plus C, C plus C. So make learning fun, okay? I'm sure we are done with the copying. So let me clean and then give you the other parts. Is somebody asking a question? I think somebody has unmuted. Eduji, do you have a question?
No, please. It was a mistake.
Okay. But please, I hope we are all following, because if you don't follow me I will unfollow you. Okay. So I've given you looking at the elements of account. Now looking at the types of account. So I've said that we have two types of account, right? So we have the personal and impersonal. The personal and then impersonal. So the P and the IMP. Permit me to use some of these abbreviations, okay? Then under the impersonal, we have real and nominal. So the impersonal are things that are not human, like land, building, goodwill, copyright, okay? But then those impersonal items, some of them are real. You can see them, you can feel them, you can touch them, like building, land, vehicles, plant and machines, equipment, fixtures. You can see these things. They are not human beings, but you can see them, you can feel them, you can touch them. Those that you cannot see, feel, and touch, like sales, rent, purchases, returning was, all those things, they are what? Impersonal. And you cannot see them, you cannot feel them. Goodwill, copyright, they are intangible, you can't see them. Okay. So the double entry for the personal is debit the receiver, credit the giver. Debit the receiver, what? Credit the giver. So please put that down.
Really, we start with friend back. Anyway, I'm in Spanish, man. I'm talking to us.
Okay, so please write that for me. So for personal account, we debit, let me write so that my professors, you know the abbreviation for debit is DR, right? So we debit the receiver. So if you see any transaction and there's a person in it, there's a person, you can do your analysis to determine whether the person is receiving or what, given. And then you can do the appropriate entry. So debit the receiver, credit the giver. So please, when they ask you to state the double entry, don't say debit the receiver. That's wrong. That's a double entry for personal account. Okay, so I want to believe you've noted this point. Now for the impersonal, if it is real, okay, then we debit incoming and we credit outgoing. So write that for the real account. We debit incoming and we credit outgoing. What it means is that if the transaction has an item you can see, feel, and touch, it's not a human being, it's not a person, but you can see, feel, and touch, like building, land, vehicle, fixtures, okay? Then when it is coming into the business, so incoming, you debit. When it is going out of the business, you credit, okay? And then the nominal is a bit, weird, but don't worry, I'll make it simple. For the nominal, we say you debit expenses and losses. So write that under the nominal. You debit expenses and losses, and then you credit income, gains, or revenue. Okay. So when they give you the transaction, you can analyze using the type of account. So you check, is there a person in this? Is there a real item here, or is a nominal item? And then you do the analysis. If it's a nominal item, you ask yourself, is it an expense or an income? If it's an expense, you debit. If it's an income, you credit. Okay. So these framework or skeletal issues, I want you to remember, like Nicole said, you need to commit to memory. So I don't know how you do it. But I think the personal one, that one is common to us. Debit the receiver, credit the giver. Make learning fun. Or when your mother comes or when your father comes home, you go to him and say, you are a personal account. So if you are receiving something, I'll debit you. Okay, Agbeku.
Sir, please, can you write the branches for the nominal and the other ones? I didn't quite hear you when you were speaking.
Okay. So I'm saying for the nominal, we debit expenses. So we debit expenses. We debit expenses and losses. Remember, expenses and losses are together. So expense and loss, and then we credit income, okay, income, gains, and revenue. Income, gains, and revenue. Okay. So I hope, Abeko, you have it now. If I pardon my handwriting, at some point it's getting to the corner. So having gotten these framework, please, we can now zoom and start applying the principle. Okay, applying the principle. So if you go the element way and you are getting confused, you can come and use the type of account to see if you can get the principle right. Okay. Okay. Any question so far? Any question? Any question? Please, I'm cleaning this. Oh, I'm cleaning it. Thank you. Okay. So now let's go back to our notes. We have this understanding in our head. So we can now start solving questions or looking at transactions. And I told you I'll take you through 10 transactions, right? So let's look at the first transaction, which is investment by the owner. Investment by the owner. Professors, every business at least has an owner or has owners. Okay? Every business has an owner or it has owners. I've not seen a business think. Yeah, let's continue. Please let me know if you can see my screen. I think it went off a bit. Okay. So investment by the owner, that was the first transaction, or that's the first transaction we are looking at. Please, would one of us read what we have under investment by the owner? Please, anybody, quickly. Oh, one kind of mommy, no worry. Okay, let me appoint someone. Fidel, please do the reading for me. Investment by the owner.
So is investment by the owner, into brackets, cash, check, or another asset.
Okay.
When the owner introduces an asset into the business, assets increase and capital increases. The two main accounts, therefore, are the asset account and the capital account. The asset account is debited because it increases, and the capital account is credited because it increases. Note: use the specific name of the asset the owner introduces as the name of the asset account. Example: cash, bank, vehicle, and premises.
Okay, thank you very much.
Should I read the example?
No, thank you very much. We'll get to the example soon. So all that I'm trying to do is to help you understand the nature of the transaction. So if the owner is making an investment in a business, we are saying the investment can come in the form of cash or check. Now, check means the person probably deposited into the bank account, right? So anytime you see check in the picture, we are referring to bank, okay? Or it can be another asset. So another asset means the person did not bring cash or any money in the bank or check, but probably the person bought land, a vehicle, a premise, or anything, okay? So if the owner introduces any investment or starts the business with any resource, professors, you can understand that the business will be getting an asset. So an asset will increase. The business asset will what? Increase. And again, the capital will increase. What is capital? The investment the owner is making in the business. So for example, Mr. Ebenezer Ewammoa is a business. Omega is my owner. Omega is giving me cash. Me, the business, so Omega, my owner, is giving me cash. What does it mean? It means that me, Ebenezer Ewammoa, the business, I'm getting cash. So my cash asset is increasing. Again, I am acknowledging that my owner is giving me resources. My owner is giving me what? Resources. It's making an investment in me. So that investment in me is also increasing. That is why capital is increasing. And the asset cash is also what? Increasing. Why cash and asset? Because Luca Pacioli says you have to look at the two sides. So if you ask the question, business, Ebenezer Ewammoa, where did you get this cash? I should be able to tell you that it is my owner. So that's why we acknowledge what is coming from the owner as capital. Please, do you get the point? Okay. Please, if you are confused, this one, no magic or anything. If you are confused, say, calm down, relax, say, don't rush. But anytime, you see, in the world of business, right, the business is normally seen as separate from its own. That's why we acknowledge whatever the owner is giving to the business as capital. So if you have an Indomie shop, you are the owner, you have an Indomie shop, and you make investment in that shop, the shop will acknowledge that you are giving it something. And that is capital. You, the owner, you are giving something, capital. But then the business will also say that capital that you gave is in the form of cash, or is in the form of a building, or is in the form of a vehicle. That's why we have the two accounts playing out here. So here we have the capital, which is representing what the owner is investing, and the asset, which is representing the particular investment or resource the owner is giving. Okay. And as Fidel read, the capital would always increase. Anytime the owner makes an investment, capital would always increase, and the asset would always also increase. Let me give an example. We are a company. We have one car or vehicle, and then the owner brings in another car. Our cars will increase, so the asset cars will increase. And again, we acknowledge that the owner is investing more, so capital will also what? Increase. And we just looked at the principle. When assets are increasing, we do what? We debit. And when capital is also increasing, we credit. And you see that this fulfills the double entry that debit and a corresponding credit. So in this scenario, we are debiting the assets, the corresponding credit is in the capital. And that makes the double entry perfect. Okay. So I have an example here. So on 1st January 2022, Nana started business with 7,000 cash. Nana started business with 7,000 cash. Who will start a business? Is the owner. So here, the owner is starting business with 7,000. What it means that the owner is making an investment in the business, but it came in the form of what? Cash. So the two elements here are the asset cash and capital. Okay, the asset cash and capital. And what is the effect? When I ask about the effect, I want you to tell me whether the cash is increasing or decreasing, or the capital is increasing or decreasing. In this case, capital is increasing, asset cash is what? Increasing. If that is true, then we have to credit capital because capital is increasing. and we have to do the corresponding debit in the cash asset account because it is also increasing. You see how simple the double entry is. Okay, great. Another nature of investment, sometimes, so I'm sure when you check your manual, you see some started business with this, started business, the owner started business. Please, it's capital and assets. Debit the asset, credit capital, as simple as that. So I have done the T account here, right? So you open the cash account because the name of the asset is cash, and then capital account. So you debit, as we saw, the debit entry is at the the left side. So you debit the cash account. What do you do there? You normally put the date and the amount. Now, here is the details. The details is the corresponding account. Okay, when I say corresponding account, in the transaction, we saw that it is capital and what? Cash. So in the cash account, the corresponding account will be what? Capital. And then in the capital account, you do your credit on the right side. So let me show that to you. Okay, the date, the details, which is the corresponding account, then you put the amount there. So this is what you were doing in school, debiting and crediting and all that. But I want to believe now you appreciate at least something, some reason, good reason behind why you are debiting capital, debiting the asset and crediting capital. Okay. Another way they can give you this investment by the owner is say, AC commenced business. Commenced the same as started by introducing her vehicle. So here, AC didn't bring cash or check. She brought vehicle. So the vehicle is an asset. So you see why it's important for you to know what an asset is and the examples of asset. Because then you'll be confused. Now vehicle, no, is it an asset or a liability? Okay. So here, the two accounts will be the capital and what? The asset vehicle. So if you want to do the recording, you open vehicle account and what? Capital account. As for the effect, we know asset will increase, capital would what? Increase. And then you do the debit and credit. On this basis, as for me, I like giving you. On this basis, let me put one transaction here and see what my professors will write. So on 15th July, Akosia invested a land worth $6,000 and cash of $2,000 into her business. So professors, what will be the double entry for this? Small one, and I want you to think deeper. Akosia invested her land worth $6,000 and cash of $2,000 into her business. I think somebody is saying something to me. Yes. Please hold on. Hold on. Michael, I think, are you saying that I should slow down? I see some symbol there which says slow down. Michael, are you lost? Are you missing?
No, sir.
Okay.
This is a mistake.
Okay. Michael, if you make a mistake again, I'll debit you. Okay. So, Agweko, I think you were saying something.
So, because I say if you can add both of them and make it capital.
So I have given the transaction. I just want to get your opinion on it.
Okay, so like I'm saying that because Akosia invested her land worth like the 6,000, I think that one is capital. Then cash of 200 into business, I think that one is capital, but I'm sure that it will be recorded inside the cash account as Debit.
Okay,
Hey,
I am
debit.
impressed. I am impressed with your initial thoughts, but need some finishing touches. The ladies, I knew if I had made it simple, you would have gotten it. That's why yeah, Nicole, let's hear you.
The land that Akosia invested, I think that's the asset.
Mm-hmm.
So it'll increase in her business, and then the cash that she used to start her business
Mm-hmm.
is also part of the assets.
Okay. So if you were asked to debit and credit, do the debit and credit, what would you credit and what would you debit? Mr. I'm wiki there. It's not me. Yes, Fifi.
Sir, please, I will debit the land and also debit the cash
Mm-hmm.
and credit the capital.
With how much? Add the amount.
Um, I'll debit the land with 6,000, then debit the cash to it 2,000,
Mm-hmm.
then credit the capital with 8,000.
Thank you. Thank you, Professor Emmanuel Fifinati. That was a great analysis of it. Okay, so you see, I intentionally did that because most of the times um, students, don't want to apply. They want what was taught to be repeated for them. No, I don't do things like that. We teach you so that you can solve complex problems. Okay, so look at it. Immediately you see Akosia invested her land and cash. You know that this transaction is an investment by the owner. So first of all, you don't have to deviate from anything. You know that it is an asset and what? Capital. So you now go into the question and check. But I'm seeing land and cash. So it means that she actually invested two assets, land and what? Cash. And it can happen. Most of the transactions you see in your books are just one asset. So when you see two assets, you get confused. But apply the principle as you know. Anytime the owner makes an investment, it is asset and what? Capital. So if the asset is two or more, you still need to acknowledge them. Okay? So here the assets were two, land and what? Cash. What are the effects? The effect is simple. Capital will increase and the assets will also what? Increase. So it means here the land is increasing, the cash is what? Increasing. Let me use the plus sign to indicate that. And then capital is also what? Increasing. So if we are to do the entries, what entries would we make? We'll make a debit entry in the land because it's an asset, right? So land is increasing and assets we debit. And then cash, another asset is also what? Increasing, we debit. And then capital is also increasing, so we do what? We credit. Now put the values in there and then you see that, oh, okay, it makes sense. So land will be 6,000, cash will be what? 2,000. What is the total capital this owner has invested? It is 8,000. You get a point. So, but if you are showing it in the account, this is how it's going to be. Let me see if I can quickly show that in the account. So you open your land, you open your cash, and then you also open the capital. So you see that even though Luca Pacioli says that every transaction has two effects, you might think that here it is 3. No, it's not 3. The effect is still 2. Just that we are dealing with 3 accounts, but the effects are 2 because there is a plus of 8,000 and another plus of what? 8,000 in an asset and capital. Okay, so the effects are still 2. Increase. So don't let the 3 account suggest you that the double entry is wrong. Okay, it's the effect. So let's say this is my land, permit me to use L. This is my cash, and this is my capital. So let me do that one, cap. Okay. So if you were recording, you need to put in the date too. So we are debiting the land. So 15th July. July is 7, right? Then what narration would you give? The land Akosia is investing is capital. So capital. Okay. Then you put the amount there, 6,000. The corresponding credit entry will be in the capital account. So you see the same 15th July. This time the narration will be what? Land. How much? 6,000. So we have recorded the land part of the capital. What is left is the cash. So when we come to the cash account, that one to debit. So 15th July. The narration will be what? Capital. The amount is 2,000. The corresponding entry will be in the capital account, a credit of 2,000 in the name of what? Cash, by the same date. So cash, $2,000. So you now see why in the capital account, the total figure will be what? 8,000. But in the cash, 2,000, land 6,000. So if you are recording in the account, this is how it's going to look like. Please, any question or confusion? I don't think so. Now you see, you need to apply the knowledge because the questions might trick you a little. I've seen a question where the owner did an investment, but that investment was even used to settle a liability. And I think we'll get to such an example. Please, any question? Any question? Ask me questions, so because I want us to be in a state where when we are done with investment by the owner, you should be very comfortable. Anytime you see a transaction where the owner is doing investment, you should be able to record it without any stress. Prof. Nicole, are we good?
Yes.
Okay, Prof. Stacy, Michael, Josiah, Jaden, Gilbert Jan, Fidel, Christabel, Amuzu, Agbeko, Adom, and we have Asante in the picture now. Prof. Asante, you are welcome. I'm sure your network, because you are late for class today. Then I have Wenam. Okay. Your silence means that you are okay. When I give you test, and then you tease. Okay, somebody is saying something in the chat. Let's see. Okay, so Michael says yes, sir. I'm okay. Great. So that is for investment by the owner, okay? Or the owner contributing capital or starting a business. That's it. It will never change. That's how you deal with that transaction. So let me clean it and then see if we can move on to the next nature of transaction. So the 11 transaction or the 10 I told you about, 1 is gone, 9 more to go. So let's go to the second one. And I'll need one of you to do the reading for me. I think a male did it, so I need a female to do the reading for acquisition of an asset. So this is where the business is going to buy or purchase or acquire an asset, okay? Who is doing the reading? Prof. Stacy, I haven't heard your voice today. Can you do the reading for me, Prof. Stacy?
Acquisition of an asset into brackets cash/check or on credit. When the business acquires or purchases an asset into the business, assets increase and another asset into brackets, but cash/bank decreases if the purchase was made using cash or check. To record debits, the asset account credits cash/bank account. If it is purchased on credit, asset increases, but a liability into brackets creditor is created, hence liability increases. To record the debits, the asset account and credit the creditor's account.
Okay, thank you for that. So who understands this English or this brofo? Anyway, let me explain. So the issue is, if a business is going to acquire an asset or purchase or buy an asset, the company can decide to buy and pay cash, or they can decide to use the bank account. So they will either give check or do a bank transfer. Or they can also buy on credit. On credit means they will not pay, or they will pay later. Yeah, it's not they will not pay, they will pay later. Okay. So the double entry depends on these scenarios. If it is cash or check, different from if it's on credit. But whether cash, check, or on credit, always the assets will increase because the business is going to buy an asset. Business na kwa asset about business no more. So the asset of the business will increase. That one is non-negotiable. The other part is, if the business paid cash, then it means the business is losing cash. Cash is going out. Okay? Cash is a real item. You can see cash. In fact, this thing, when you get to the university, they will tell you cash is not real. But now you appreciate it as cash is real. You can see cash, money. Okay. So if it is going out of the business, we credit. If you use the analysis of an asset, cash is an asset. If you are paying cash, then it means cash is decreasing. That asset is decreasing. So you credit. Okay. If they paid check, that is bank. Bank would also decrease because you are withdrawing money from your bank account. But if they didn't pay, which means it was on credit, then yakodeka, so a liability. Because we didn't pay, we now owe. And anytime you owe, a liability is introduced. So the liability there becomes who? The creditor. The creditor of that asset. So in that case, a liability has been introduced. And if a liability has been introduced, it means the liability is increasing. Because first, you were not owing, now on the car. Because you went to purchase the asset on credit, so your liability will increase. And if liabilities increase, what do? We credit. So when the business is buying an asset, when you see a transaction where the business is buying an asset or purchasing an asset or acquiring an asset, which can be land, building, vehicle, fixtures, you see all the things that we learned as examples of assets. You need to know and remember them. Okay. The asset will increase. If they bought with cash or bank, it will decrease, so you credit. If it was on credit, a liability, so you open a creditor's account and you credit it. Please, has it entered? Or I should relax more? Let me relax more for you to process this information. So let's say your mom or your dad or your parents are running a business, and then they go and buy a computer and they paid cash. You should be able to tell your parents that, oh, open this account and this account, credit this account and debit this account. You should be able to do that. Okay. Because you tell your, okay, you have gone to buy an asset or you have acquired an asset, computer. So computer will increase in the business. So you open computer account, an asset, it is increasing. So you debit computer. You paid cash, which means cash is going out of the business. So an asset is decreasing with credit. So you tell your parent that, Daddy, open a computer account, debit it. open cash account and credit it. Then your parent will know that, oh, my son or my daughter is learning accounting. Because I know some of your parents are running businesses and they don't keep records. You have to keep records for them. Do the double entry. Because sometimes when they are going for loans, they can ask them to submit their account. Or when the tax authorities come, they'll check for their account. So record it for them and let them pay you. You keep it in your bank account for future. Anyway, how many of you have parents who are running businesses? Because you have to make this thing practical. So anything you learn, you go when you say, Daddy, today let me record your transactions for you. What transaction have you made today? And your father will tell you, this small accountant, you want to collapse my business. How many of us have parents who are running business? It could be a sole trader or a partnership or anything. Oh, none. Oh, Munjaisa, I know your parents are doing business. Munjaisa, Prof. Santa Michael, your parents, somebody is giving, who? Michael, your parents, what business are they running?
There, please, a super.
You see that sole proprietors, they don't even like, keeping records. So you can start. Well, go and buy a book. They say, Daddy, today you have made sales. Okay, let me record for you. You show him that you are learning. The school fees and the chop money is not in vain. At the end of the month, you calculate his profit and say, hey, Daddy, this is the profit you are making. Hey, Daddy, this one you are making loss. But I think that you spend too much on expenses, so cut it down. So your parent will feel your relevance of the accounting you are doing. Okay, I think another person also put up the hand. Yeah. So I'm sure by the time we finish with double entry, if you go and record account for your parent, or if your parents have accountants, you can audit the accountant to see whether they are doing the right entries. Then you alert your parent. Maybe the accountant will be doing some gymnastics. You show the accountant that, hey, me too, I'm there. But please be sure, don't go and give fake apple. Don't go and give fake apple if you don't understand. That's why you need to understand it. So don't go and tell your father to do a credit when he's supposed to do a debit. Okay, that's just by the way. But please apply these things in your daily life, okay? Even you yourself, when you go and buy a shoe, you can open a shoe account, okay? You debit it, you open your cash account. If you paid cash, you credit it. Then you say, okay, it makes a lot of sense. Record keeping is good. Okay, so I have an example of such transactions here. One of them is bought furniture and fittings by check on 4th January 2022. So here we know that the business is buying an asset because furniture and fittings are assets. Okay, and they bought it by check, so that's the bank. So here we have furniture and then we have bank. In terms of the effect, the furniture will increase because the business is getting more furniture. And bank will decrease because we are making payment. You create account from bank, so bank, so better, it will decrease. So if you apply the double entry principle, furniture and asset is increasing, we will debit furniture. Bank, another asset is decreasing, so we'll credit bank. Okay, so that's how come we have, bank account, we are crediting it, and then furniture, we are debiting it. Okay. And I think I have another example here. Acquired 2 plots of land with cost of 1,005 per plot on credit. On credit. So if you buy the asset on credit, the two accounts will be the asset and then the liability. That's the creditor. So here you bought it on credit from Ford Metrics Limited. So from Ford Metrics becomes the creditor. So you open that creditor's account. Okay, and you credit because it's a liability and it's increasing. So if you see the entries here, we have the land account and then the creditor for metrics. Okay, so you credit the creditor, you debit the asset because the asset is increasing and a liability is also what increasing. Okay. I think we'll wrap up today's class on the sale of goods because that is what prompted this whole revision. Prof. Christabel, let me hear you.
So please, I just wanted to ask if you could just write the name of the creditor as the title instead of adding creditor and then the name of the creditor.
Okay, so I tell my student plenty fish does not spoil soup. Okay, if you learn it that way and then you see a transaction where they didn't give the name of the creditor, they just said bought a land on credit, you see that will be confused. Okay, because the main thing there is a creditor, right? So if the name of the creditor is given, it's more or less like a bonus. So I tell my students, it's a creditor, acknowledge the creditor, but if the name of the creditor is given, add it to it. So creditor Ford Matrix. Okay. Yeah, that makes your work well defined. Okay. Thank you for your question. But seriously, I really love my professors. So you guys, you ladies and gentlemen, you are good. Just that some few people have been missing class. Yesterday we were about 20, but and only 14, excluding myself, 13. For calculating subjects when you miss class. Yeah, Prof. Nico.
So please, can you go back a bit?
To the
Don't see the capital and liability one. Number 2.
Is it about copying the notes? Is it about copying the notes?
Yes, I just wanted to see it.
Don't worry, I'll share the full document. If I forget, remind me. If I call me, say you said you'll share it too, I'll share it with you, okay? I need to give you the notes, so don't worry, I'll give it to you. Like I shared the book of accounts, I'll share this one too, the accounting equation. But please, don't go and print and sell it all. It's not copyright. You remember copyright. If you print for academic purposes, fine, I'm happy. I think I'll add my details there, my name and my number, so that they'll know that, oh, this is the person who did the note. If you go and copy and sell and I catch you, copyright. Anyway, I know my students will not do that, okay? So let's move on. So we've seen 2 transactions, so investment by the owner and then purchase of an asset. Let's go to the third one, which is sale of goods. Sale of goods. Sale of goods. So at least if we do 3 today, next time we do another 3 or even 4. But as we go ahead, it becomes simpler, so we can run faster. Sorry about that. I think I need some water. Should I add the sale of goods, or you think the 2 transactions are enough? You don't want to confuse yourself. I think we can add the sale of goods so that we stress ourselves
on
a
the
little.
second one again. So
that's the purchase of asset.
So is it the second one?
Yeah, the second one is the acquisition of asset or purchase of asset. Let me add acquisition or purchase, or when you buy an asset. Okay. Aboko, is it the one you are referring to?
Yes, please.
Okay. Anyway, let me know what you understood, and then maybe I'll fill in the gaps for you. So what did you gather about when a company or a business purchases an asset?
I got to understand that when a business purchases assets from let's say a different company or the marketplace, they credit the the other companies, they credit their accounts, then they receive what they bought through the debit place.
So you credit the company if the business bought it from the company on credit. If the company paid cash, then the credit will go into cash account. If the company paid by check, then the credit will go to the bank account. So you only put it in the company's account, as in the company from which you bought the asset. You only open their account as a creditor if the business purchased the asset on credit. Okay. But the debit is always in the asset account. So if you bought furniture, you open furniture account and you debit it. That one is non-negotiable. But the credit, it can be in the cash account, the bank account, or the creditor's account. So it's cash when you paid cash, bank when you pay check, the creditor's account if you didn't pay, that's the transaction was on credit. So note these points very well. Okay.
Okay, sir.
Okay. Well, I don't know for you, but I think I appreciate our discussion so far. Yes, Christabel.
Account on, let's say, furnitures on 15th of January, and you go and buy another furniture on, let's say, March, 3rd of March, are you going to account it in that same day?
Okay, so I get your question. Yes. When you are preparing or when you are doing the double entries, you don't open, different account for the same item. So for example, January, you bought a building. February, you bought a building. July, you bought a building. You don't need to open building. No, you have one building account in which you record all these because all the transactions are related to building. So you just have one building account. The same applies to cash. You might have paid cash for a building. You might have paid cash to a creditor, or you might have received cash from a debtor. You open one cash account. We don't open several cash accounts. No. Okay.
Okay.
Thank you. Yes. More questions. I think we're almost wrapping up. So more. Yes, Ewenam. Okay. Those who don't ask questions, I want to believe that you are okay. That's cool. I wish I could say this off recording. Yes, Prof. Nico.
So please, after you're done recording in the T account, do you have to do some sort of conclusion or something?
The conclusions we do in account, we call them balancing of account. So when you are done, you need to balance off and extract a trial balance. I don't know if you did that in school. So don't worry, we'll do that conclusion you are talking about. You balance it, and that's where you get your balance carried down, balance brought down. When we get there, you appreciate it. Okay.
Okay. So and point 2, acquisition of an asset.
Yes.
The example that I gave over there, so bought furniture and fittings by cash too.
Okay.
2,000. An increase in assets and a decrease in.
Okay. So it was bought furniture and fittings by check, right? So the effects were assets, furniture, and fittings will increase. So there's increase in assets, furniture, and fittings. And another asset, bank, decreases. Bank is decreasing because we are paying with check. Okay. So if the asset is increasing, we debit. That's why we are debiting the furniture and what fittings. And then bank, which is another asset, is decreasing. And when assets are decreasing, we credit. That's why we credited the bank. Okay. Okay, professors, I think I would pause here on the second transaction. We'll do the sales and purchases and the others in our subsequent. Let me go back a bit, do a review or a summary. So I started with the lesson by telling you that there is a principle in accounting which we use to record transaction, and that's the double entry principle. This principle came about because of a certain man we called Fra Luca Pacioli. He says that for the double entry principle, he says that every debit entry, there should be a corresponding credit entry. And for every credit entry, there should be a corresponding debit entry. So if you are crediting 5,000, you should have an equal debit of 5,000. So if you credit 5,000, you should have an equal debit 5,000. If you debit 5,000, you should have an equal credit of 5,000. That's the corresponding. So you realize that even in the example that we did, that land, cash, and capital, the example I gave, the debits were equal to the credits because the capital was 8,000 credits, and then the land and cash together also summed up to the 8,000, which was the debit. Okay, so that's the principle. It should be equal. There should be no difference. Now, the meaning of the principle is that when there is a transaction, you have to assess to get these two effects. How do you assess it? You can assess using the element of accounting. And I introduce us to the asset, capital, liabilities, expenses, and income. And I give you the application of the principle that if assets increase, we debit. And so I even give the, the fun kind of learning. A plus debit, A plus debit. So asset increase, debit. And then capital increase, credit, C plus C, C plus C. Capital increase, the plus is increase. Capital increase, credit. Okay. If you understand that part, then I introduce to you that you can also use the type of account. And I mentioned that in accounting, we have two main types of account because transactions are with persons or non-persons. So the persons are the personal account. But I didn't restrict persons to only the natural human being, Kofi Ama Adwa, I said MTN, KK Limited, and Taraba Chopba. These are businesses, but we see them as what? Persons. And then we have the non-persons or impersonal, like computer, equipment, vehicle, land. These things are not persons. They are not human beings, whether natural or artificial. Okay, but even under that, we say we have real and what? Nominal. The real are those you can see, land, equipment, fixtures, okay. And the nominal are the expenses like rent, salaries, postage, telephone, bills, electricity bills. These are nominal. You cannot see. If you can see electricity bill, I'm sure by now electricity bill will be in in the emergency units or intensive care unit because people will beat electricity bill, but you cannot see electricity bill. You cannot touch it. So it's nominal. Okay. So I said, if you're applying it based on the type of account, then for personal, you debit the receiver, you credit the giver. For real, you debit incoming items, you credit outgoing items. And then for the nominal, we debit expenses and losses, we credit income, gains and revenue. Okay. And then we now came to look at the transactions, the first one, the second one, which is investment by the owner and acquisition of assets. And we're applying the principles we learned. So far, I think we are applying the elements, assets, liability, capital, asset. So far, the first one and what? Assets. And when we did the analysis, we saw that if the owner makes investment, capital increases. So you credit capital and asset increases, you debit the asset. So let me pause here. I'll share the notes for those who want to read further, but if you get confused, please don't just stop. When we meet in class, we'll continue. So I'll pause for a few questions. I think in the next minute, if there are any questions, concerns, please bring them on board. Let's deal with it. If not, I will call it a day. By the nature of our discussions, I'm not sure I'll give you any assignment until maybe we have done like 10 of the transactions. Then I'll begin to give you assignment. Yes, Amuzu.
please, why is it that debit, credit, we debit expenses for the nominal side? Because we are losing it at some point, isn't it? Credit instead of debit.
Are you saying we do debits and credits in the is it person in the nominal? In the nominal, we don't have any personal. The nominal account has no person there. Okay.
Yes, sir.
So the nominal is
about you debiting it.
we debiting the nominal.
Yes, you are like we debit expenses.
Yes.
Why is it that? Because expenses will lead to a loss. Doesn't it mean that it will leave?
Okay, so yes, I understand your confusion. How I get my student to appreciate that is, okay, let's take for example, you pay for rent, okay? When you pay for rent, who actually is giving? It's not the rent, it is cash because you pay the rent in the form of cash. So technically, an asset cash is decreasing. So you credit cash. And who made the cash decrease? Rent. So technically, rent was receiving the money from cash. So even if we want to assume that rent is a person, then in that circumstance, rent was receiving the money from cash. That's why we are debiting the expense rent. Okay, but rent is not a person, it's a nominal. So we say anytime you incur an expense, debit it. So when you pay rent, debit it because it's an expense. But for you to understand, I'm saying let's assume rent is a person. The question is, if you pay the rent, who is actually doing the payment? It's not rent, it is cash. You are using money to pay for that rent. So in a way, rent is getting or receiving from cash. Do you appreciate that?
Yes, sir.
So even if we assume that rent is a person, in a transaction where you pay rent, rent is not the one giving. Rent is rather receiving. From who? Cash. Likewise, when it comes to the income, you would say that income is receiving. So why do we credit and not debit it? Listen, income is not receiving. Income is rather giving the money to cash. So for example, you make sales is an income or revenue. So if you sell goods, you get money, right? So you are making sales, you are receiving money. The money is cash. So cash is receiving the money from who? Sales. Sales is giving the money to cash. That's why we credit sales. Because sales is not the one receiving. It is rather sales given to cash. Because you say that, nesikani free, where is the money coming from? We sold goods. So sales is bringing the money or giving the money. I don't know if you appreciate these, illegal analysis I'm making. Do you get it from that perspective?
Yes, sir.
So even when you get confused with the nominals, assume that they are persons and do the analysis well. You will see that in terms of expenses, the expense is not received, it's not given, it's actually receiving. Okay, and I think I've been able to convince you with the scenarios I put in, because who paid the expense? It is cash. So technically, cash was giving the money to that rent expense. That's why we debit rent and we credit cash. Okay. So thank you, Pops. Any other questions? I think I have some 5 minutes to wrap up. Any other questions? But please don't go and assume that rent is a personal. I did that for you to understand and appreciate. But rent is not a person. Rent is a nominal item. Okay. Okay, so on this note, I would want to thank Adom, Agbeko, Amuzu, Asante, Christabel, Emmanuel, Fidel, Jaden, Josiah, Michael, Nicole, Stacy, Ewena for being in class. And special thanks to those who asked questions and contributed. Those who didn't ask questions and didn't say anything, no problem. I love you too. But next time, I beg you, talk small for Mr. Amwa, because if you don't talk, I suffer from silent deuces. On that note, I wish you all the best. I'll see you another time.
Bye bye, sir.
Okay, bye. The ladies, they don't like saying bye. I don't know.